The conference room is silent, tension thick in the air. It's 2009. The phones buzz incessantly, each ring a harbinger of more bad news. Traders stare at their screens, disbelief etched on their faces as the numbers plummet. Everything they've built teeters on the brink of collapse, the ground shifting beneath them. What were the causes and consequences of the hedge fund that vanished overnight due to the implosion of situational awareness? In the mid-2000s, a new era of prosperity seemed to dawn. The housing market boomed, with prices climbing higher each month. At the center of this financial frenzy stood a hedge fund, riding the wave of optimism and risk. It was a time when easy credit and adjustable-rate mortgages promised the American dream to many. Borrowers, eager to own their slice of paradise, took on risky loans, buoyed by the belief that property values would only rise. But beneath this facade of wealth, cracks were forming. Mortgage originators wielded increasing power, pushing risky products into eager hands. Homeowners, enticed by attractive loan terms, overextended themselves. High personal and corporate debt levels loomed ominously, their shadows growing longer with each passing day. As the housing bubble swelled, so did the stakes. Millions of Americans pinned their hopes on the continued ascent of the market. It seemed unstoppable, until it wasn't. The first signs of trouble were faint whispers, quickly dismissed. But soon, those whispers would grow into a cacophony that no one could ignore. The year is 2006. In a sleek Manhattan office, the hedge fund's top brass gather, eyes gleaming with ambition. They saw an opportunity in the surging housing market, a chance to redefine financial success. Their strategy was bold: leverage the booming housing prices and the burgeoning world of mortgage-backed securities. The fund's managers, confident and daring, embraced risk as their ally. With each passing month, the fund's assets grew. Investors, hungry for returns, poured money into the fund, dazzled by its meteoric rise. The managers, emboldened by their successes, pushed further into the complex web of financial products. They capitalized on the easy credit environment, crafting innovative strategies that promised high returns. It was a gamble, but one they believed they could control. As the housing bubble expanded, the fund's profits soared. The managers reveled in their triumph, celebrated in financial circles as visionaries. The fund's name became synonymous with success, its returns the envy of Wall Street. They had ridden the wave of prosperity to its peak, and the view from the top was intoxicating. But beneath the surface, the foundation of their empire was eroding. Adjustable-rate mortgages began to reset, and borrowers struggled to meet their payments. Foreclosures started to climb, a slow yet steady tide. The whispers of trouble grew louder, but the fund's managers remained confident, certain they could navigate any storm. In the spring of 2007, the horizon darkened. The first cracks in the housing market appeared, subtle yet undeniable. The managers faced a choice: adapt or hold their course. Their decision would soon be tested in ways they never imagined. In September 2007, a chill swept through the corridors of power as the Federal Open Market Committee began to ease monetary policy. The air in the hedge fund's Manhattan office grew tense. The whispers of trouble had turned into a steady drumbeat, and the fund's managers felt the pressure mounting. They gathered around the conference table, faces drawn with concern as they debated their next move. The housing market's decline was no longer a distant threat. It was a reality crashing down around them. Adjustable-rate mortgages reset, pushing borrowers into financial distress. Foreclosure proceedings surged, with 310,000 initiated in the final quarter of 2006 alone. The impact was felt across the financial spectrum, and the hedge fund's once stable foundation began to tremble. The managers watched as the subprime mortgage market unraveled. Serious delinquencies for subprime ARMs soared to 11%, and more than 1 in 5 subprime adjustable-rate mortgages became seriously delinquent. The fund's exposure to these toxic assets became a ticking time bomb, set to explode at any moment. As the stock market faltered, shedding $8 trillion in value, the hedge fund's managers scrambled to reassess their positions. The once certain returns from mortgage-backed securities now seemed like a mirage, disappearing into the desert of financial ruin. The fund's strategy, once hailed as visionary, now looked reckless, its risks laid bare for all to see. In the boardroom, tension crackled like static electricity. The managers faced an impossible choice: cut their losses and retreat, or hold firm and hope for a turnaround. Their decision, made in the crucible of crisis, would seal their fate. The clock was ticking, and the weight of their choices bore down like an impending storm. The moment of no return had arrived. The morning after the meeting, the hedge fund's office was eerily silent. The managers had gambled on a turnaround that never came. As the financial markets continued their downward spiral, the fund's assets evaporated overnight. In the aftermath, the numbers told a grim story. The U.S. stock market had shed $8 trillion, a staggering loss that reverberated through the global economy. The housing market's collapse hit homeowners hard, with nearly 30% reporting a decrease in their house values. Foreclosures became a harsh reality for many, with roughly 1.5 million initiated the previous year alone. The fund's portfolio, once a beacon of prosperity, was now a liability. Subprime adjustable-rate mortgages, once lucrative, became a noose around their necks. More than 1 in 5 of these loans were seriously delinquent, a statistic that spelled disaster for the fund. Amidst the chaos, the Federal Reserve's actions provided little solace. The target federal funds rate was slashed by a cumulative 325 basis points, but it was not enough to stop the bleeding. The fund had been too exposed, too leveraged, and now it was too late. The managers, once hailed as financial wizards, watched helplessly as their empire crumbled. The fallout extended beyond their office walls, contributing to a severe recession that left millions unemployed and disrupted the flow of credit worldwide. In the end, the hedge fund's demise was a cautionary tale of hubris and the perils of ignoring warning signs. But as the dust settled, a new question loomed over Wall Street: who would rise from the ashes to claim the throne? The hedge fund's collapse was not just a financial disaster. It was a stark reminder of the dangers lurking in unchecked ambition and the illusion of invincibility. At its core, the downfall was fueled by a cocktail of overconfidence and risky mortgage products that concealed their true peril. The fund's managers, blinded by past successes, failed to heed the warning signs flashing all around them. As the housing market crumbled, their empire was built on a foundation of sand. This story serves as a critical lesson for businesses everywhere: the importance of situational awareness and the need to adapt in times of uncertainty. Yet, as Wall Street grappled with its ghosts, one question remained unanswered: who would rise to learn from these mistakes and seize the opportunity? In the eerie silence of the hedge fund's office, the truth was stark. They never saw it coming. The implosion of situational awareness had been their undoing. Blinded by ambition and the allure of risky mortgage products, they ignored the storm signs. As the housing bubble burst, their empire crumbled, transforming overnight from a beacon of prosperity to a cautionary tale. The collapse wasn't just financial. It was a reminder of the perils of unchecked ambition. Now, the financial world looked ahead, wondering who would rise to learn from this catastrophe and seize the opportunity.